Next, Patrick, let's talk about the price of oil and the 5-year bond yields. Now, I think we should start with oil first because you really wanted gloat on this prediction you made. I'm going to give you that opportunity to gloat because sooner or later you were going to be right, and this might be that window of opportunity where you might be right for a little while.
I know this pisses you off when I'm right, but you know something? I said months ago, sometime in about the third quarter of 2023, we're going to see oil prices come up. As much as oil prices seem to be at a low right now, I look into 2023, I can see them doing nothing but rising. You, on the other hand, Mr. EV, and all of this, you're going, no, 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 oil's going south because everybody's going to be driving electric. Not going to happen tomorrow, but it's going to happen. So listen, when oil prices go up, they inevitably also pull back. But here's a fundamental that we need to touch on. Number one, oil prices are up and they are going to continue to increase. Now, to your point, I didn't say it was going to go to the moon by the end of 2023, but we're going to see some significant changes in oil prices. And when I look at my analysis and I look at my thesis around it, I'm seeing that happen. So why does that matter to people? Well, first off, the cost of food, the cost of fuel is going to continue to increase. That's just the reality of what happens when oil prices go up. That's nothing profound about that observation. That is, in fact, what happens. OPEC and Saudi Arabia have cut back production. Russia's cut back production. Now, here's what's interesting about this, JG. Guess why they've cut back production? China is crashing. China is crashing. So regardless of what we think of China and this boom and this kind of bravado that they've been putting out there that they're amazing and all these things are going on, what's actually happening in China, they are actually, some are saying, collapsing.
You're kidding, right?
And when you look at what happened with a lot of their real estate and how they do real estate, guess what? We're seeing the economy in China start to slow dramatically, which of course will decrease demand. So I think we'll see oil go up quite a lot. The U.S. has cut their production. They're working on reserves still. It's kind of kooky what the U.S. has done in that regard with Biden has pulled off. Just kind of nuts. So we're going to see those prices increase. And then I think we'll start to see a pullback in late 2024. It's not throw a dart like you do, JG. I'm not throwing darts. I'm putting time frames in there. And because China's economy is slowing dramatically, and I think we have to pay attention to that. So just some food for thought around oil prices and what that will eventually mean to us. So what we're going to see when those oil prices come down, we'll actually see some deflation in certain categories.
Let me just congratulate you and give you a round of applause for your incredible prediction. Because as I look at this chart, which they're going to put up on the screen here, it actually was pretty much July 1st where essentially we hit the bottom and oil has been steadily climbing since, which is officially Q3. So congratulations, Patrick. I mean, your prediction was just incredible. And now your next prediction, if I heard you right, was that you're going to see a pullback in late 2024, I think is what you just said. So we just want to.
We're going to see significant. We are going to see significantly higher oil prices. There'll be some short term, maybe a little bit of pullback here and there, but it's going to go way higher.
I think what you're telling me off air before we started here, you were already bitching about the oil prices in BC being $2 a liter, which is equivalent to $8 a gallon plus. And you're telling me that you're really excited for your Tesla EV truck, which you also ordered, just so everybody's very clear that this is happening. Is that what I'm hearing?
Listen, I'm hedging my bet. That's all I can tell you.
Okay, fair enough. So oil prices. Now, what about 5-year bond yields? Let me put up on the screen the 5-year bond yields. Since 2021, it has been steadily climbing. Obviously, that was right in the heart of COVID. And essentially since now this chart here there, Patrick, that I'm showing is just, it's up to today, essentially up to today, as in when we shot this, 3.942 is where the 5-year bond yield is right now. And what people need to know, especially investors, is this is how mortgage rates are determined, fixed rates, not variable rates. Variable rates are determined by the Bank of Canada rate, overnight rate. But the 5-year bond yields, that's why we always talk about the bond yields, because this determines where the fixed rates are going, especially 5-year fixed rates. So based on this, Patrick, we see rates going up. If it keeps going in this direction, 5-year fixed rates are not going to come down anytime soon.
It doesn't look to be that way. And, certainly on the next slide, if we want to show it at some point, we started to, the reason I went back to that time frame was if you start to correlate back in 2009 when bond rates were again up in that range, you start to see where interest rates were. It's just an interesting correlation. It all is pretty, I guess it all makes sense regarding where bond is versus the 5-year fixed rates, and even where variable was. So it's just a comparative and understanding what these bond yields mean to us as investors for mortgage rates, interest rates.
There's essentially been a spread, let's call it a spread between variable and 5-year rate. There's been a spread of 2.5 to 3.25, 3.5%, pretty much all of the time in the last 10, 15 years. And now the spread is down to 0.09%, less than 0.1%. So it's essentially 6.40 is a variable rate and 6.49 is a 5-year rate. So, and that, the spread is definitely tightened up. Interesting to see where that's going to go, Patrick.
Yeah. Well, I think, nobody knows. Let's face it. Nobody really knows. When we look at, you and I talked about this on previous shows where, some of the frustration that everybody's experiencing with what the Bank of Canada is doing is they've raised them quickly. They've raised them a lot. And they seemingly haven't allowed for the lag that has to work through the system when they increase rates. So a lot of people are really struggling. You've got premiers of provinces like begging and pleading for the Bank of Canada. Ford came out with this whole is it a tirade? Sure. And he just trash talked the Bank of Canada. This is all on you. And of course, the federal government. And, when you look at just what the government borrowed to feed into all of the pandemic and the issues that we were dealing with. So we've got premiers in Vancouver and definitely in Ontario, not Vancouver, but premier of BC, and then Ford. And I want to say Alberta, maybe? I don't remember. Anyways, the point is this. They're all begging and pleading. Bring those rates back down where they belong. You're putting a lot of pressure on people, and it's all your fault.
But before I scrunch this sticky note, Patrick, it's important to note, and this goes back to the conversation we just had about OSFI rules. It goes back to the conversation that we had at the height of the market. These are interest rates are influencers. They have an impact on the market in the short term. That doesn't mean it's like short term as in months. It could last years. But the point is, when you invest in real estate, you're investing for 10, you're investing for 15, you're investing for 20, 30 years out. And you have to have that view. And I tell you right now, Patrick, in a number of years, interest rates will be where they'll be. They might be a lot lower than where they are. They might be a little lower than where they are. They might be exactly where they are. They might be a little. The point is that someone's going to say, I should have bought the dip. That's what investors are going to tell themselves in 1 to 3 years. They're going to say, I should have bought that dip. And I just want to caution investors and say, listen, if that's what you're going to, if you're going to tell yourself that, then take a real hard look at this market, because you should never let interest rates determine your investing decisions. They influence them. They don't determine them. And I think that's important.
Well, JG, just to share. Now, I'm not saying that this is what anybody should do. This is not advice. I have my own scenario where I have got a commercial light industrial property that I had to renew, and misery loves company. And I looked at the rates that they were offering, and they ranged in the, from, I want to say 8.65 or something to 9.25 for an open variable. And I looked at it, and I looked at the spread of the difference in, let's say, payment. And I went, something, I'm going to hedge my bet. And I took an open variable at 9.25%. Now, was it the right move? I have no idea, but I also know that interest rates are going to fluctuate. Will they bump up a little bit? Yeah, maybe. I don't know. Right now, I think that when we look at what's happening economically, they're going to be hard pressed to continue to raise rates. Some would argue that point. They're going to say, just look at bonds. I just don't agree. And already, and I can't remember the country where inflation is at 10%, they just dropped their interest rates 2%. So was it Greece? I don't remember.
You're not talking about Moldova or some obscure country like that, are you?
It was a little bit more major than that, but having said all of that, I'm hedging my bet. Now I've got a residential that I have to renew. It's not a big mortgage, but the point is that I'm looking at rates, and I'm looking between 5.85 and 6.25, I think. I don't know if those are exact numbers for an open variable. And I'm looking at the spread, and I'm going, something? I may just go variable. I may just stick with a 1 year open variable. Give me some flexibility, give me some options. And it's in Edmonton, and I might be just liquidating stuff in Edmonton. That's a different conversation. I want the flexibility, and the spread is not enough to kind of make me go and say lock down for 2 or 3 years, because I don't trust the Bank of Canada or our federal government. That's it. I want flexibility.
Oh, Patrick, I knew you'd bring it around to the federal government sooner or later. So
Can't help it. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
if you want to see more stuff like this, click here. If you want to see the entire show, click there.